we're basically at $1 trillion deficit already, and that's including 1 month with Trump or whatever it is. So it's basically the last 3 months of Biden versus in the last month, the first month and a half, 2 months of Trump. You're at over $1 trillion deficit, and so now we run into a situation where if you do have slowing growth later in the year, and your interest costs are still at $1 trillion, and your tax receipts come down, then you're really in a panic, because that will cause a massive migration of capital.
Larry, thank you very much for joining us today. How are things in Panama?
Excellent. Nice to be on the road. The speaking tour, the book is really doing well, especially, Latin America, North America.
Good. I want to ask you about that. Before I do that, though, I want to ask you why you decided on Panama. I speak to investors all over the world. I just spoke to somebody recently. They're in the Grand Cayman, somebody else in the Bahamas, somebody else in Costa Rica. Why did you decide on Panama?
Well, we wanted to grow the business throughout. If you're going to fly to Brazil or Chile, if you want to develop a business in South America, it's great to have a hub in Panama. And we looked around the world, and it just had this ingredient of infrastructure, incredible access to the hub, the airlines that operate in Panama have great diversity into South America and to North America, and quality of life, taxation. There's a lot of what I've noticed over the last decade, the amount of high net worth families that either have a backup plan somewhere is going up dramatically, whether or not they're people that don't like Trump that want an exit, or people that didn't like Biden and Kamala that want to. I mean, it's incredible how many people now have a backup plan to the United States.
Yeah, very interesting. You didn't mention Trudeau.
There's a lot of Canadians in Panama. I mean, it's incredible. And, there's better taxation advantages for Canadians than Americans, though.
Oh, my God. Don't even start talking about taxes. And this is one thing a lot of people outside of Canada don't realize. We're continuously being taxed on after-tax dollars. It's virtually impossible to get ahead here. But I don't want to talk about Canada. I want to talk about your new book. You just made mention of the fact that you're on the road quite a bit. You're traveling also through North America, South America, Europe. And I'm curious, when you're speaking to these groups, what sort of feedback are you hearing? What are people really concerned about now? Because there is so much going on in the world.
Well, most investors have been in the 2010 to 2020 portfolio. In 2022, we had a stagflation scare that the Fed put that out with rate hikes. But now interest on the debt is around $1 trillion, and tax receipts in the United States are, call it, just a little under 5 trillion. So when your interest costs relative to your tax receipts get up near 20%, relative to the developed world, like Germany's at 1.5%, and maybe Italy and France, the bad boys in Europe, are maybe 4 to 5%. The United States is interest costs as a percentage of tax receipts is getting up near 20%. And so over the last 5 years, people kind of got comfortable with that 2010 to 2020 portfolio, even in the face of 2022 stagflation. But now, with the second bout of slowing growth, elevated inflation, people are really starting to rebalance their portfolio construction. And our vision in the book, How to Listen When Markets Speak, is that we're really going back to a 1969, 70 to 1980 portfolio construction, which had much more contributions to hard asset companies, and the percentage of companies in the S&P 500 that were value or hard asset driven, whether it be gold or oil or metals and materials, those percentages were a lot higher in a stagflationary world.
So I totally understand why people are so concerned about the debt, and I just want to mention one point. When Trump first came to power in 2016, the federal debt was at $18 trillion. And you just mentioned it's now at $37 trillion. Interest is well over $1 trillion, and it's only going to skyrocket here in the coming years. But I'm surprised this is the number one concern with a lot of investors. And because I would just think with everything that's happened here in the last 3 months, it would be trade wars.
No, yeah, it's trade wars. But what I mean is, let's say you have a trade war that's slowing growth. Um, Tariffs mean, at least the perception is, I mean, the media says it every day, 100 times a day. The perception is trade war equals tariffs and slower growth. That's stagflation.
Okay, so I want to talk about the debt a little bit more. And because, as we just mentioned, the interest expenses are well over $1 trillion. And how is the current administration going to finance this debt? Because this is one thing that you and I have spoken about in the past. The previous administration has really put this current administration into a real bind.
Well, Biden did something very interesting in the last month of his term, which was the first month of this year, I guess the fiscal year. Um, if you look at it, we're basically at $1 trillion deficit already, and that's including 1 month with Trump or whatever it is. So it's basically the last 3 months of Biden versus in the last month, the first month and a half, 2 months of Trump. You're at over $1 trillion deficit, and so now we run into a situation where if you do have slowing growth later in the year, and your interest costs are still at $1 trillion, and your tax receipts come down, then you're really in a panic, because that will cause a massive migration of capital. And the one important thing, probably the most important takeaway from this sit down, is you got to remember Sarbanes-Oxley. Now, this was a piece of legislation that came out during the dot-com bust, and it forced companies to be more forthcoming around earnings. And what we've noticed is when there's a rate of change in the economic data, the amount of companies, whether it be FedEx or Delta Airlines, United Airlines, there's at least 30 companies that dramatically changed their outlook. And that rate of change was really spectacular relative to the last like 5 to 10 years. But the street economists and the street strategists on Wall Street, they're not beholden to Sarbanes-Oxley. So they've been hiding out at $270 of S&P 500 earnings projections. And if you look at what the CFOs are saying on one hand and what the street's saying on the other, the real earnings for the S&P 500 are probably, if you believe the CFOs, are probably not 270, probably 230. And that means you're really trading at, potentially 24, 25 times earnings up here, even up here, 5,600-ish, 5,700-ish. But if you throw an 18 multiple on there, like a lower multiple, then the S&P should be at 4,100, not 5,600. So these are the types of things that people are trying to process right now.
And I guess the other big issue the government is facing right now is how they're going to finance all of this debt, because a lot of it's coming due here in the coming year. Maybe you can just tell us how much is coming due and how do you think they're going to refinance it?
So that's the big wild card for September, because right now we're at the debt ceiling in the United States. So there's no new debt issuance, but it's it's a $17 trillion year where that amount is rolling over. And right now you can, as bonds come due, the Treasury can issue that amount. So we're at the debt ceiling. So we run an institutional chat with hedge funds, mutual funds, and pension funds in about 30 plus countries behind me. And the one thing I'm hearing from the most sophisticated institutional investors is that when you get to September, the debt ceiling will be fixed at some point in probably August. We have a piece of legislation on the Hill in Washington right now around reconciliation. But once they raise that debt ceiling, then the Treasury has to catch up, because remember, from January to September 1st is pretty much no new debt issuance, and net debt issuance. And that means there's going to be a spectacular comeback or kind of catch up. And we think there's going to be a Liz Truss moment later in the year where they really have to juice, um, those bond sales to catch up, and that's where you can probably run into some very interesting times later in the year.
Maybe you can just expand on that. When you say a Liz Truss moment, what exactly do you mean?
Well, Liz Truss was a politician in the UK that came up with a very ambitious plan around tax cuts and things like that. And if you think about the GOP in the United States, they want to cut taxes, but like I said, interest as a percentage of interest as a percentage of your spending is very high. Interest as a percentage of of your total budget is very high. So if you try to cut taxes, you're going to lower tax receipts. The theory is that you will increase tax receipts over time, but in the near term, you're lowering your tax receipts while your interest costs are still pretty high. And that is starting to freak out the bond market. So if you look at what the GOP is putting together on the Hill, they want to raise taxes through tariffs, which is fine, but they really believe they can raise $200-300 billion, but then they're going to cut taxes and with tax cuts, and so that whole dynamic of tariffs would slow down the economy, and then cutting taxes. There's kind of like a gap where you could get the growth on the other side to make up for the tax cuts and get higher tax revenue. That's the old Laffer curve, Laffer theory, where tax cuts lower tax revenue immediately and then give you a big tax boost as the economy grows. But there's a gap in the middle, and that's kind of what happened in the '80s, where you have high interest rates, high interest costs. The growth isn't there yet, and then you're really in a stagflationary world. That's where your oil names dramatically outperform your copper names, your gold and silver, and your Mag 7 type growth names, underperform. That's what the market's starting to tell us.
And so the Fed's really in between a rock and a hard spot because they got to get interest rates down. But at the same time, this inflation continues to be very sticky. And we just had the Fed increase their inflation expectations for 2025 just recently. What are your thoughts on inflation?
So they've been playing a game with inflation. The Biden team in the last year did almost another $2 trillion deficit spending, and at the same time we cut interest rates 100 basis points from September on, and so we have all these secular inflationary forces that are really not going away, and they're creating, like, if you look at inflation expectations, they're creating this like bounce in inflation. And so once you get a weaker dollar because of slower growth in the United States, which we're already getting, the dollar's down a lot, that's going to further, feed into inflation. And so the Trump team is trying to slow things down to calm that down, but it's going to take a lot, because what Stan Druckenmiller, what a lot of the great traders, investors have always said is that once inflation gets above, say, 6, 7, 8%, it gets under the seat cushions, it gets under the carpets, and it just takes so much unemployment to get rid of that. And so it lingers and lingers and lingers. And that's what the '80s and the '70s, '80s, and early '90s were all about.
Yeah, I saw an interview with Paul Tudor Jones in late 2024, and what he was saying about 2025 was that all roads lead to inflation. And so it looks like it's happening because it's not going away. That's for sure. So I want to talk about the U.S. economy now and get your thoughts on that. Can't believe Q1 is out of the way, and here we are in the early part of Q2 already. But we've already seen profit warnings out of the airlines. Delta, American, and Southwest all came out with profit warnings. They said a large part of the decrease in profitability and flying has to do with the uncertainty associated with the trade wars and the tariffs. We've seen other companies come out. Walmart actually came out and they took their expectations down for 2025. Once again, just citing uncertainty associated with the current economic environment. Nike also took their numbers down. But what are your thoughts on the U.S. economy, and do you think there's concern for a recession this year?
Yeah, so if you look at the Atlanta Fed or the New York Fed, a lot of these regional bank surveys, they all point toward, like today, the Dallas Fed, they all point toward a dramatic rate of change that is pretty rare. And like I said earlier, Wall Street's caught still in kind of the bullish camp, but the rate of change of all the data, and like you said, the way the transports are acting, the way that to us, one of the great leading indicators are the tertiary financials. So your Synchrony Financial, your One Main, your subprime lenders, your Alley, they're all telling you that we're coming to a hard landing kind of recession. And so, and you look at bonds, I mean, the bond market, bonds are rallying pretty violently into higher inflation expectations. If you look at break evens, the 2-year break evens are going dramatically north, and that's inflation expectations. At the same time, the 10-year, 5-year treasury are rallying and lower in yield. And that's telling you that it's just, we're coming into like a slower growth period, probably inflation with probably recession with sticky inflation. That's going to really force. Right now, there's still 24 trillion in the Nasdaq 100. In 2022, when we had this kind of like stagflation scare, there was 20 trillion in the Nasdaq 100, and by the end of the year, it was a little bit more than 12 trillion. So at that time, almost $8 trillion moved from growth to value over to hard asset companies. And right now, so far in February, we had 27 trillion in the Nasdaq 100. Now we have about a little bit more than 23. So far, the Nasdaq 100's lost close to $4 trillion. And that money is moving into gold miners, European equities, global value, your EWU type funds, and all kinds of companies that control assets in the ground.
So I want to ask you about the hard assets or real assets, but before I do that, I just want to continue on with this one point you made about bonds. The 10-year has been very volatile this year. It's currently trading around, or has a yield of around 420, but it's got as high as 470, as low as 380. What's this volatility telling us?
It's telling us that we have a problem in Washington around spending, tax receipts. A new administration's coming in that's promising, all this growth in the long-term deregulation, but they want to take the pain as far away from the midterms as possible. And we've said this in our reports in November and December and January in our Bear Traps Turning Point reports. That if you talk to people on the Trump team, they want to take the pain as far away from the midterms as possible. That kind of translates into the bond market into, one day you're worried about stagflation and higher inflation, the next day you're worried about slower growth. That's creating this kind of violent moves in the bond market. And the bottom line is, that those lower yields are pointing toward a big slowdown because they're lower yields with high inflation.
And to your point, this is what you mentioned earlier, but they want to get the rates down. They want to cause some short-term pain, slow the economy down, get interest rates down, and this is going to help the refinancing.
Yeah, that's the problem is you have to, like, Janet Yellen issued, so the Biden team, the Treasury Secretary Janet Yellen, she issued 2 to 3 standard more T-bills than longer dated bonds. And all that means is she issued a lot of like 1-month bills, 3-month bills, 6-month bills, 1-year bills. And so we have a tremendous amount of debt. We're almost like an emerging market country. We're financing the United States of America on the front end of the yield curve. And that is a very bad recipe. That has to be termed out. The Trump team knows it. And so they're trying to create some stress to get yields lower so they can sell bonds and they can lock in those 10-year bonds at lower yields.
She's probably sitting around in some private club right now having a scotch thinking she did a great job.
Well,
or maybe a sherry. She looks like a sherry.
I'll tell you one thing. Both Republicans and Democrats, the only way out of a $37 trillion debt hole is there's 2 ways. A debt jubilee default, which we talk about in the book, How to Listen to Markets Speak. One more plug there. But a debt jubilee default like in Argentina, or which is a reset, or just a massive financial repression, which is just trying to push interest rates down below the rate of inflation. And once you do that, you can monetize that and get out of it, that kind of $38 trillion debt hole.
Right. And when you say a giant financial recession, you mean like a serious recession like we saw
Well,
back
I'm
in
sorry, it's a financial repression.
repression. Okay.
So, so the financial repression, all that means is like forcing the banks to own more treasuries, forcing Japan, our trading partners, to own more treasuries, and get it. Maybe the Fed comes in and buys treasuries, but forcing bond yields or interest rates below the rate of inflation. If you can do that, you can inflate your way out of the debt.
So, as an investor, if I'm trying to position myself for such an event, I always look at the TLTs. That's why I play bonds. So right now it's trading around $90. I think it was as high as 170 back in 2020. How should an investor play these TLTs?
Okay, so the TLTs rallied quite a bit over the last 2 months because Scott Bessent and Trump and tariffs are scaring things. You can own the TLT here, but you want to be careful because in the old days, your upside with bonds, in other words, your downside in yields versus in the old days, 2010 to 2020, if you had an economic slowdown, you can get a 1.5% 10-year. And in that case, the TLT would would go from like 92 up to maybe 120, but if if rates, because of structurally higher interest rates and inflation and stagflation and real irresponsibility in Washington by Republicans and Democrats, if rates are really at a higher plane and inflation's at a higher trajectory than the old days, which we think it is, then you want to make sure you maybe want to think about the EMLC, your emerging market local currency bond fund, which if the dollar's weaker and you have that, you basically just want to have a bond portfolio that is diversified across the world instead of having, too much exposure to the United States.
You mentioned a term earlier I want to ask you about now, and that's capital migration. And with all this uncertainty we're seeing in the U.S., we've seen a lot of money flow out of the U.S. The S&P was down 10%. It's only down 5% now. We've had a nice little snapback here in the last few days. But at the same time, if you're looking at Q1, a lot of money's moved into Europe. And the DAX, for example, it's up 15% year to date. The FTSE not up as much, maybe 5%, but we've seen a lot of money flow out of the US and into Europe. Do you see this trend continuing?
Yes, because at the end of the day, um, if the United States is in a fiscal contraction mode, if you look at what we called American exceptionalism, the strong dollar, everything was driven by massive fiscal spending. And when you massive fiscal spend, you get higher interest rates that drives money into the United States. And your deficit spending is like 7% deficit spending per year in the United States versus Europe was like down at 3%. But now the United States is in a fiscal contraction mode. Europe's in fiscal expansion. And the valuations, like I said earlier, you're probably right now at 23, 24 times earnings on S&P 500 companies because we're slowing down. And in Europe, you can buy companies at 14 times and maybe 15 times. In Brazil, 12 times. So we've reached the point where, because we're no longer in American exceptionalism, massive deficit spending, we're in fiscal contraction mode, that's starting to force money outside the United States. And that's what's causing this migration of capital. So you want to think about the EWU portfolio, which is a global value basket. And if you look at the top holdings, your BHPs, your Rio Tintos, companies that own a lot of hard assets and commodities.
And so if we do get a big contraction in earnings in the S&P for this year, where do you see it going?
Yeah, I think like we're going to go probably down to $220. And you throw an 18 multiple on that, instead of like a high multiple. What happens is when you're in a slower growth environment with stagflation, stocks should trade at 15 times earnings. if 15 times earnings, and you're down at 18 to 15 times, and you're down at 230, you're basically somewhere between 3,500 and 4,300. And so, and the S&P right now is at 5,700. So that's a big correction in the market. And if you look from 1968 to 81, the market was flat, but oil names were up 60%. So look at stocks like Weatherford or stocks like Schlumberger, great earnings power, buying back stocks. You can look at the OIH. You can look at ETFs in the coal space. The coal names are very cheap. So you just want to, at the end of the day, what you want to do is, if interest rates are relatively high and inflation's high relative to history, the DCF model, which is discounted cash flow model, you want to be in companies that have assets in the ground. Different types of companies led the market from 1968 to 81. It wasn't big growth stocks like Google or Facebook or Amazon. It was companies that actually, your Rio Tinto type companies, your Newmonts, your Barracks, those types of companies, your Exxon Mobils. Right now, Exxon and Chevron's combined market cap, these are the two premier oil companies in the world. The combined market cap this month was only 29% of NVIDIA. I mean, think of that. The combined market cap so if there's 24 trillion in the NASDAQ 100, close to 3 trillion in NVIDIA, as money migrates out of that kind of growth into value, that's where a whole new portfolio construction is going to start to reappear. And like 3, 4, 5 years from now, even a year from now, you could see, big oil or commodity companies back in those top 10, 20 names in the S&P 500, your Barracks or your Newmonts.
And so, okay, so you're bullish on oil, bullish on nat gas. What about gold? You touched on it earlier.